Ladies and gentlemen, thank you very much indeed for your time today. I'm actually very delighted to actually put together another MGAA Shape and Share session, and this afternoon's one is entitled Appeasing the Regulator, and if we can do that, I think we'll be halfway there. This Shape and Share session is your chance to actually interact with our guest speakers, which is Sarah Ager and Andrew Pixgill, all about this lovely topic of conduct risk management. Sarah is actually well known to MGAs, has previously worked in one of the MGAA's larger members. She's a partner of EC3 Legal, and today she's actually representing EC3 Consultancy, make sure Consultants, that's it, which is a brand trade name of EC3 Legal, which is actually plugging the gap between the legal operation and their corporate governance and their operational side. Sarah actually has an in-depth working knowledge of the MGA world. I'm also very pleased to introduce Andrew Pixgill. He too has worked for an MGA in a previous life, so he does understand the environment very well. He's a former founding director of Plum, the MGA, and he moved into Woodbrook, as you know, is now part of Penn Underwriting. Andrew moved over to Markit Systems, and he provides MGAs with an insight of the operations and the regulatory requirements that we need. Many of you will also realise that recently Lloyd's reviewed their minimum standards on conduct, and both Sarah and Andrew will give a flavour of this important work. One of the major issues facing a capacity provider is access to meaningful data, but more importantly, how and when that data can actually be accessed. This piece of work established glaring holes in some of the quality of that data that was actually captured, and also the effectiveness of some of the documents around this particular issue. Therefore, as MGAs, we need to ensure that our monitoring of conduct risk is robust, and that robustness should identify issues before they are escalated to become major issues and major problems. And without that monitoring issues, such as complaints, we can actually fall foul of FCA expectations, and we don't all want to see a 166 put on top of us in that respect. Ladies and gentlemen, this is your session, and as such, I have great pleasure in introducing Sarah Ager and Andrew Pixgill.
Thank you, Peter. Okay, so because this is a Shape and Share session, these are the learning objectives that we'd like you to focus on today. This is really seen as an update on the training I gave on conduct risk last year for a number of you in the audience. And because it is a Shape and Share session, it's not just going to be Andrew and I up here talking at you, so it's going to be slightly more interactive. The first half of the afternoon will be run by Andrew and I, so I will give you a quick refresher on what conduct risk is and how it impacts in your business and how it should be embedded in your day-to-day business practices. Andrew will then look at conduct risk from a data, MI and feedback loop perspective, and then the second half of the session we're going to give you a case study for you to have a look at, and then we're going to be taking your views on feedback on how the problem which is set out in the case study could have been averted. So I hope that's useful. As Peter said, the first half of the session will be recorded. The second half, when you share your experiences, won't. So I want you to treat this with Charterhouse rules and feel that you're able to share that which you can without getting yourself in trouble internally. So please take it as such. Okay? So as far as conduct risk, well, you know, it was never defined by the FCA deliberately. It's a principle-based idea, and really it's never started with treating customers fairly. So it was first kind of discussed as a concept way back in 2011. But actually, conduct risk as it stands is still an item on everyone's agenda. I don't know if any of you have looked in the press today, but the FCA have published their first consultation of the IDD, sorry, the second consultation on the IDD this morning, and they're asking for feedback on 4 areas, one of which is conduct of business requirements, and they're asking for the feedback from the industry before June of this year on the concept of how firms should act honestly, fairly and professionally when meeting customers' best interests. And they're also asking, does the market think about appropriate pre-contract disclosures about themselves and the scopes of their services? I think that probably means commission remuneration and how it's split down the distribution chain. So you can see that it's an ongoing area of discussion and debate. Also, conduct risk isn't really one idea. It's wider than treating customers fairly. It's about governance, risk and responsibility. SEMA was introduced last year for insurers, and it's in the pipeline for MGAs next year. We're yet to see what that looks like from the regulator's perspective. But the important thing about conduct is, within the organisation, the firm itself understands how they interpret conduct risk, and most importantly, that their personnel and ultimately their customers understand how they will be treated. And that's all about culture and consistency and identifying areas through the use of MI, how you can improve that customer journey and the outcome for the ultimate customer. So what's actually happening? Well, a quick plotted history. I mean, for those of you around this table, everyone says that the financial crisis was going to break us all. Well, fortunately it didn't. But actually it was the tipping point, I think. For me, that was when behavioural regulation came into effect. So no longer was it about what you can and can't do. It was all about actually how you're perceived and how you feed in those things to your strategy and risk. Between 2010 and 2014, over £200 billion worth of fines and penalties were levied against the banking sector in respect of conduct-related issues. And although so far insurers have managed to escape lots of these huge fines and penalties, my view is it's just around the corner. And as the regulator gets to understand more about how the distribution chain within the insurance market works, then there'll be more scope for those fines to be levied against us. Peter made reference to the Lloyd's thematic review, which happened last year. I know we're MGAs, but the outcomes of that thematic review, I think, are relevant. Of the 60 managing agencies that were part of that thematic review, only 6 got a rating of green. 10 were okay, and 44, it said, needed to do more. Well, reading between the lines, does that mean that they didn't really understand it? The problem was, I think, that those managing agencies failed to document responsibilities and their strategies and their risk management of conduct and what their appetites were. So that's really key for MGA businesses, particularly if you rely on Lloyd's capacity. We cannot, I don't think, any longer sit on our laurels and wait for our insurers or our capacity providers to tell us what our conduct should be. There is this inherent conflict between regulation and fiduciary responsibilities for the MGA business, but I think we need to be brave enough to come out there and have our own risk strategy and framework. Now, what I mean by that is, as an MGA business, you all know your ultimate fiduciary responsibility will rest with the insurer, so you step into their shoes and you are their agent. The regulatory responsibility rests with the insurer. However, if you're going to be an interesting proposition, and actually if you're going to attract the right business, and also if you're going to be able to demonstrate that you are looking after customers, and many of you here will be developing your own product offerings, then you already have to have an understanding of what your conduct framework is, because culturally that's key so you can deliver to your insurer clients. So there is this kind of niche area. Now, I was fortunate, I suppose, when I was practicing an MGA business, because it was one of the larger of the two. So the larger you are, probably the more weight and clout you have about setting your own strategy and framework. So my advice to you is that you need to develop a strategy and an appetite which is both commensurate and appropriate for the size of the business that you're in and the stage in your development. And by that I mean doing more than just monitoring complaints. Complaints is not enough. You need to establish with your insurer who's responsible for the product. The RPPD in March of last year expressly stated that just because a product is owned and developed by more than one organisation shouldn't expose that customer to any different if that product has come from one place. So what that effectively means is, if you're distributing a product which has been developed by insurer clients, you must still look at it from the customer's outcome of that perspective. So customer journey, although I hate the terminology, is actually really key here. What is also clear from the findings is that lots of people are collating data, but the collation of data is not enough. You know, that's only stage one. The importance of the data is that you do something with it and you feed it up to your organisation and to your insurer at different levels, such that within your organisation and your insurer level, you actually seem to be doing something and you report and you act upon that data. Culture is incredibly difficult to measure, but you need to make a start and stand for what your culture of your company is going to be. And that should be included within your vision and strategy and your business planning process. For instance, we all have new niche ideas, and when you're looking at those and you're developing them, before you even put them to your insurer customer, you should be identifying what the conduct risk implications of that new product is. Are the customers vulnerable? How are you going to distribute that product? Is it going to be digitalised? Does the customer need some information? How is that information going to be sent to them? And all these things, I think, will lead you to attract better paper as an MGA, but also allow you to demonstrate that actually you take conduct seriously. The good thing from our perspective, I think, as the UK insurance industry, is that the rest of Europe, and indeed Australia and South Africa, are looking to us to lead the way. We've already got principles of conduct embedded within our regime here. So, you know, the fact that Brexit's there, I don't think that should change your opinion on conduct or how you interpret conduct if you have European branch offices, because I think they're all looking to mimic and follow the way that we've set already. So what can we do? Well, I've worked with a number of organisations, and in fact I have worked in my own organisation and put together what I term rather grandly the strategy and the appetite around conduct risk. Really, what I would advise you to do is keep things simple. You have to retain the flexibility to define conduct within your own organisational setting. You can't wait, as I say, for your insurer clients to define it, because firstly, they may not have defined it themselves, and secondly, they're delegating to you niche areas of business which actually may not have the same conduct principles. For instance, if you're aiming at digitalising the distribution of your product, that might be attractive to your insurers. They actually might not be used to doing that themselves. So there are kind of small nuances you need to take account of. Also, my recommendation is that you do need your own strategy and philosophy, because for those of you out there, you know, gone are the days where you had one capacity flyer. So you might find yourself whereby you place 5 different products with 5 different insurers. So the question for you is, well, as an organisation, what does that mean from a conduct perspective? Well, actually, if you've already defined it within your own strategy, you can refer to your insurer clients about what your strategy and philosophy is. You'll probably find that the data is pretty similar, and that's the underlying information the insurer needs. You should be doing that yourself. So your framework would depend on the size of your MGA, the complexity of your MGA, and your own perception and interpretation of what good customer outcomes look like, i.e. what conduct looks to you as an organisation, given your product style, your product status, and your product offering. You will need and you should be defining your own risk indicators. And by that I mean is, what are those triggers from your MI that require action, i.e. how do you feed that back into your product loop? You should also make sure that your incentivisation programs and your remuneration programs are built in and are reflective of your underlying concept of conduct. These are clear issues, particularly if you're a broker-owned MGA, and quite a lot of your business is first-party business. The IDD is asking us to be clear and concise. Okay, it's not live yet, but it's only just around the corner. And what we can help you do is identify how that business, how that data can help your business not only to improve, but grow, and also to refine its product offerings and how it looks after customers and ensures good customer outcomes. Only once you understand what good looks like are you able to develop your own culture to make sure that your business is reflective of the needs. Quite often, my experience is that the MI is collected, but actually it's too voluminous to do anything with. So we have lots of Excel spreadsheets of data, gives it, well, conduct is compliant, look at all this data we capture. Actually, but the important thing is that within your business, you have the structures and the committee structures, i.e. the governance, which allows the feedback of that information. And the feedback of that information then needs to disseminate into the sales process. And that's the bit that most people, I think, are missing still. They're collecting the data, but actually they're not acting on it appropriately. So on that note, I believe, oh, here we go, sorry. On that note, I'm not passing over to Angela, I've got one more slide. So this is the kind of phased approach that EC3 could help you with, and this is the kind of thing, or the kind of process that I think you need to be running yourself. You need to look at what your current processes are. You know, what do you have in place? I'm not saying reinvent the wheel. The most important thing is to see what you already have, because actually if what you already have is in place, it probably means that naturally that's what the culture of your company is, but lots of people are failing to document what their conduct is. So you need to look at what's already in place, see if it's robust enough, and then actually write something down. You need a framework documented, and this is where lots of the managing agencies with the Lloyd's thematic review fell down. And that necessarily leads you to how the data is monitored and measured. And by that I mean during the whole of your distribution chain. So, you know, you need to be collecting that information from everyone that actually is involved in your distribution. The appetite, well, I would be recommending that the appetite should be set by your board. Some of you might decide that the appetite be set through your insurer, but once again, I think the key from the MGA's perspective is you actually record how the appetite is set and what that appetite is. It's not where it's come from, it's that you actually know what you're looking towards and what you're benchmarking yourself against. And by that I mean really what good looks like, i.e. how do you balance good outcomes for the customer with a great system of incentivization and rewards for your staff. And therein lies that constant dilemma between what good looks like. So now I'm actually going to pass over to Andrew about the MI challenge. Thank you, Andrew.
Thanks, Sarah. So, what I'm going to try and do now, very, very briefly, is summarise how we at Markit Systems have taken the conduct risk challenge that exists for MI and looked at the data and seen how we can create some form of generic process that we can then offer to clients that is not fixed. Ultimately, it's very flexible, enable you to adapt, or we can adapt to your business itself. So that's what I'm trying to do here, that's what I'm trying to show you. And I'm going to start by reading that, because it is quite important. It says, business must be able to compile adequate conduct management information for it to determine whether it's treating its customers fairly at all times. Now, we started with this with a number of our UK clients, and we went, right, okay, so we've all got a reasonable amount of experience, but what does this really mean? What are they trying to get from this? So we realised that we're going to need a legal and compliance input pretty quickly. So, luckily, I know Sarah very well, so I phoned up Sarah and said, look, I think we've got a bit of an issue here. How are we going to resolve this problem? And in essence, what happened was this sort of joint initiative was born. They are looking to provide a solution for clients, and the clients need data. Here we are to help them with data. So that's the background. What is the reality? From this, we've taken away, had a look, and in much discussion, come away with 5 key points. First one, a key requirement is data. We've then got understanding, we've got customer focus, insight, and finally, assurance. The key requirement has to be reliable and consistent MI. Time and time again, this is always the challenge, certainly in my experience has been trying to get the same correct data month in, month out is very, very frustrating. Whether it's from your own system, whether it's from a software house that's selling your product, or it's even the claims department of your capacity provider who are supposed to be providing you with consistent information. Even then, there are challenges. So it's really important that this is addressed at the beginning. And if you have the ability to automate the quality assurance side, then you're immediately a winner, and you can save hours and hours of manual checking. Understanding the market sector. Where are you in that market sector? The product development. Is it achieving what you want it to? Does it need to evolve? Should it be there anymore? Sales and distribution. Who's selling your product, and how they're doing it, and how well they're doing it. We move to the customer focus, that great one, TCF, experience, outcome, all those things. That's really the customer journey from the moment the client or the customer gets a quote to the claim they're experiencing, the service during the claim, and then hopefully the renewal process. Insight, performance, the performance of the product. What's your loss ratio? What are the take-up rates? The product need. Is the product needed? Is the demand great? Is it too great? Is it too little? And finally, benchmarking. Can you compare yourself, or you should be able to compare yourself not only against your own estimates, but the estimates you had from the previous year, but also if you compare yourself to the rest of the market, then you're doing well with it. And finally, this all falls into the assurance piece, which provides the regulator, your capacity provider, the board, and senior management with the necessary information to prove that you are meeting that risk appetite. Okay, so that's fine. We've got this. What do we now need to do in order to corral this data and actually produce some answers to the questions that are falling out of those 5 areas? Our solution, as the smart ones amongst you will have noticed, you can see the little diagrams again. We're in Sarah's little presentation. We've come up with some control modules. They are product design, sales, customer service, complaints, and claims. And we're looking at taking each of these areas and using those to ask of the policy, claims, and service level information provided on the products, loads and loads of questions to produce the data that you need to actually make a decision about the conduct risk elements of the book. It produces reports. Those reports then get pushed into the feedback loop that Sarah was talking about. Now, there are 5 there. They've all got their own sets of questions, and we don't have enough time today for them to waffle on for hours about each one. So what I will just do is very briefly touch on the claims area and how we at the moment have interpreted it. I must stress that it's how we at the moment have interpreted it. Obviously, it's going to be unique to your business, so please take these elements can be modified. So let's look at the claims. Here we have 6 elements: claims volumes, determination, call abandonment, denial rates, time to settle, and whether risks have been, or claims have been, risks have been terminated or avoided because of those claims. Each one of those will produce either a number per month, and then subsequently a cumulative amount per month for the given year, or it will produce an index to enable you to compare, an index related to time, so that you can compare one month against another. You can then take each of these and compare against your own estimates for the year, your previous year's performance, and the marketplace. And each of these will then throw out a whole load of graphs and data and things like that, and it's entirely up to you how you present those in a dashboard. I here have just shown you a very simple graph with some bars and lines on it. The aim of that is to show at the bottom here you've got blue boxes, those are claims per month. Not surprisingly, the red ones up there, that's the cumulative for the year. And here we are comparing against last year, which is the purple line, and the estimate that you thought, or the business thought, that it was going to suffer, or the claims it was going to have during the year. But you can do all sorts of things with this. This is just one example of how a dashboard, one part of the dashboard, one part of the dashboard that we can create. So ultimately, what does good MI and good data bring you? Well, each control module will have its own dashboard bespoke to the business. It will enable you to benchmark against your own performance statistics in the market. It enables you to analyse trends. It also gives you the ability to look at your customer outcomes, what is good, what is not good. Gives you the added bonus of being able to develop the product, so if you know you're going well in one area, can you put more information into that, or it's not going so well, why isn't it going so well? It's a direct link to that feedback loop with right level, right data at the right level. And finally, and I think very key, illustrates to your capacity provider, to the underwriter, that the MGAA actually knows what it's doing. And it is right on top of its data. Or put it another way, it's definitely on top. It knows what it's doing, it knows all about its data before the actuary in the capacity provider tells you what it was. So, that's a bit of a rattle through with the PMI. What we're looking to do now is to sum up everything we've talked about over the last half an hour or so. Points to take away for your good selves. Conduct risk must be embedded into the business. Product governance, obviously, is absolutely key. You need to set your own strategy and conduct risk appetite. And if you do that, that really clearly leads you in a very good position when you're dealing not only with the regulator, but with the capacity provider. Make sure you capture the right data and make sure you disseminate it properly. And finally, state how you're going to measure your outcomes.
So quickly moving on to stage 2. This is where you don't listen to Andrew and I. This is we were quite fortuitous actually, because on the 17th of February, one of my favourite people, the director from Sports Direct, had a nice big for selling products to lots of customers. In fact, 330,000 customers, which the FCA said they were sold insurance of, and I quote, little or no value. So being handed around at the moment is a picture of that very beautiful man, and the very easily digestible, even in standard version of this material, because we didn't need to take too much time reading it. And what I'd like you to do, if that's all right, is amongst yourselves, consider some of those questions amongst others, and see how and if it could have been averted if they'd looked after it from a conduct perspective. I think we've put some flip charts and some pens on your tables. I know this is a bit placeable-y, but if you could scribble down some of your responses, and then we'll give you 10 minutes, and then perhaps get some feedback and some questions as well that arise from this press release, if that's all right. I mean, I don't know what you all think. I mean, maybe we need to be wrapping this up because I'm conscious of time. Yeah. But I think some of the key themes, I mean, you've spotted them all. It was a pretty obvious case example. One of the key things to me is the culture of the organisation, and the fact that the board allowed this to happen. If they had a conduct risk or any kind of risk strategy, then I think it would have been identified earlier. The customer demographic, I think, is key to this product offering, and the information that did or didn't get sent to that customer. Which takes us back to the product. Who owns the product? Who developed the product? And what the devil is the product? It looks to me, reading between the lines, actually there is no real product here. So we are selling them an empty piece of paper. And because we didn't explain that, and because we had a potentially vulnerable group of customers here, that they thought they'd just take it. You know what it's like when you go onto one of those websites and they say, do you want travel insurance? You go, oh shoot, yes, I better tick that. That's a tick box, I better tick it. And I suspect that that's how they've been selling this product. So there was a number of issues, I think, with this raised for me. But I think for me, with compensation of 12.5 million and all those customers being impacted, I'm still quite concerned that actually not that many people know about it, even though it is our friendly man from Sports Direct. So that kind of brings... Sorry.
Refund or a fine?
No, it's compensation. They're returning it to the customer, so I don't know if that... Presumably that's a return of premium and something, yeah. It doesn't say how the compensation's made up. And I think that's all to do with voluntarily fessing up to keep things secret there. So I hope you found that useful. The case study, I hope, kind of concreted some of the ideas that we raised today.
As you know, we please show your appreciation